Right. Good morning, everybody, and welcome to this week's weekly show. I'm going to run through the news this morning, and then we're going to bring Andrew McHattie on for his regular beginning of month slot to talk about the major moves in the sector. And then this week's special guest is Charles Jillings, who's going to talk to us about Utilico emerging markets. There's quite a lot to get through today, so I'm just going to try and push through this quite quickly. Try and give you the key bits, but probably as always, you may wish to go back and have a look at some of the other stuff on the website, but we'll try and direct you to there and give you the interesting bits. But without further ado, let's push on. So, news this week, things I wanted to talk about. HICL Infrastructure, and kick off with that. That has done some interesting disposal, and it is going to be using some of the proceeds to fund a share buyback. I've grouped a number of things under renewables just because we've had some interesting results. I'm going to do a bit more of a deep dive into Bluefield Solar and then just a bit of a read through to Trig and Greencoat UK Wind. There's also a number of interesting announcements and results in the property sector this morning. I'm going to cover a couple of those and point to another couple as well. So thing with HICL Infrastructure, it has sold Northwest Parkway, which is a toll road project in Denver. This is a 75-mile public toll road per hour charging, 23 structures, 3 major interchanges, 4 ramp toll plazas. The key reason I'm saying that this is a big piece of infrastructure, is a significant asset. And the really interesting thing is that HICL sold its share for about 232 million US. They're saying it's around a 30% premium. If you look at the small print, at the time of writing yesterday, it was 34%, because obviously there's a exchange rate issue here, but assuming that stays roughly where you are, you're looking at a 30% premium, and that was the 30 September valuation. Just put a little picture in the bottom to give you some idea, because I had no idea what this thing looks like, but obviously, as I say, it's a major piece of infrastructure. Why such a chunky premium? Well, and there are a couple of things here. HICL says that really they were able to get all the shareholders to come together, and they were able to sell it to one strategic buyer as a whole thing, which allowed them to get a more premium valuation for it. And I think one of the key reasons that the buyer was so interested, and this applies to us, a lot of these infrastructure assets, very strong inflation correlation, particularly over the past 2 years, which made it very, very attractive for them. Obviously, there'd been a lot of due diligence done on this, so obviously they've got a pretty decent price. I'm not suggesting for a moment that they would get that for everything, but it gives you some hint of what the value is in the portfolio. Completion expected in Q2 this year. Now, interesting thing is this brings total value disposals to over $500 million during the last 12 months, which is something they've been saying they were going to do. They have been actively recycling the assets. Key things within that is they've sold assets across a range of sectors and geographies, and all of those have been at or above their respective carrying values in the NAV, which I think really underpins the validity of HICL's NAV. And obviously, with rising interest rates, etc., a lot of investors have been concerned about the validity of the NAVs and interest rate exposure, etc., etc. But I think this transaction in particular shows the extent to which public markets are undervaluing these assets. I mean, HICL's discount to NAV is circa 23%. If you look at the following chart, actually, I don't think the NAV here reflects the uplift that's going to come. So if anything, it's going to be a little bit higher. But it gives you some sense of, and this is something we've been talking about for quite a while, the strength of the NAVs and the valuation opportunity here, and the fact that actually longer term private asset or private investors are putting higher values on these things. And these are quite scarce assets in public markets. I mean, there are not a lot of tow roads around, and a couple that certainly there have been taken out in the last couple of years. Other interesting thing just reflecting discount is of that 232 million US, chunk of it's going to go to paying down its RCF, although they will be looking at other opportunities, and they are specifically going to allocate £50 million of the proceeds to a share buyback program, which has benefits of being NAV accretive, and they hope it will help dampen down share price volatility. That program at this stage is going to run for 12 months. Bluefield Solar, good set of interims from them. There's some interesting mechanics in here. that I wanted to run through. So revenue growth 16.5% compared to the sort of same 6 months in the prior year. And this is despite sort of weakening of spot prices. Actually, solar radiation has been quite a bit below budget. I mean, one of the things with this asset class, solar, obviously you've got a bit of wind in there now, but solar is very, very predictable. With sort of 95% confidence, you can expect it to be plus or minus 7% in any given year. So sort of 13% below budget is probably quite unusual. And also, their sort of West Raynham site, which is a 50 megawatt site, was not available for the first 3 months of the period. So that would have dragged on production as well. And you do see that sort of in the NAV bridge later on. But probably the key thing is it's not as bad as it would have been because of the strength of their sort of short-term PPA strategy. So they don't tend to, as you sort of see in the US, these guys don't lock themselves in for sort of extended periods, but actually they think their sweet spot is about sort of 6 to 36 months. They've got this good visibility of where they think power prices would be and where the current spot price is and where it makes sense to lock in more or lock in less. And they've been very good over a number of years of adding value with this strategy. Key thing is pricing environment has softened, but actually they were able to lock in a decent amount. You see this in the next slide when prices were stronger. This, to say, was a slide from their analyst briefing. It just shows where we are today. Obviously lower prices, but 90% capacity fixed at higher prices. Middle of the year, that's a bit lower, 73%, but no doubt they'll be locking in a bit more as we go, or maybe not, just depending on what happens with the environment. But you can see, decent prices locked in through Jan 25 and through to the sort of middle of next year. There has been, and this is a common theme with the renewables funds, there has been a little bit of drop in the NAV. They say positive inflation impact offset by dividend payments, but there are these operational issues as well. Key things, actually, directors' valuation, discount rates unchanged, 8%. That was hiked sort of from 7.25% in June 22 for the December 22 valuation. It's fixed despite interest rates coming off a bit. Inflation assumptions also unchanged, so 3.5% for this year, 3%, 25 to 29, dropping to 2.25% thereafter. Obviously, if inflation comes in higher, there's a lot of inflation linkage here, so you will get to see that uplift in the NAV if that comes through. And if I just drop through to the NAV bridge, you can see some of this stuff here. So 139.7 pence at 30th of June. They've managed to add 1.1 pence from de-risking a lot of the projects they've got under construction. That's come through. As I said, higher inflation, that's added 1.9 pence. Power price forecasts, they've actually moved up the margin. That's added 0.4p. They've actually got a bit more than they thought they would get from Regos, so that's 0.9p. But the operational issues I outlined before, they've sort of dragged, despite obviously getting the better prices with the PPAs. And obviously dividends, as you would expect, would detract. Key things, they have reiterated their guidance for full-year dividend, at least 8.8 pence per share. At a gross level, this is 3.3 times covered by revenue. Actually, it's over 2 times covered, they expect, once you've factored in sort of debt repayments, etc., etc. And you can see this with sort of some of the others, they're very positive on the outlook for power prices. They point out that war in Ukraine is continuing to affect power markets, although acknowledge that obviously the world is adjusting to this. Obviously, the world has to look to other energy sources, and with transport issues, there are new routes and new methods for transportation. But even so, pricing they expect to be better than where it is. War in Gaza has obviously effectively shut the Suez Canal, so there's a lot of vessels are now having to go around the Cape of Good Hope. That's extra costs, longer journeys, creating pressure on shipping capacity and greater uncertainty in energy supplies, and they don't have those issues, so that is ultimately potential upside for them. Next chart just illustrates the extent of the discount, 22%, 8.4% yield. And as I say, there's a lot of sort of issues where the operational issues that have brought down the NAV, they look like quite short-term phenomena, so you can see some recovery there. And as I say, probably more upside, or the risk seems to be to the upside with pricing anyway. Sort of similar story elsewhere. I just wanted to briefly touch, just got the one slide on Trig and one on Greencoat UK Wind. Trig, 10 years old, its annual results, underlying performance is strong. They say cash generation has never been healthier. Managers also been creating additional value in the portfolio. There has, like BSIF, been a modest valuation decline. They basically say lower price forward contracts and higher discount rate. You've got to bear in mind, this is a sort of 12-month thing, 12-month set of results as opposed to BSIF's interim. BSIF had already baked in the sort of discount adjustment or discount rate adjustment there. They also say, despite actually good progress, challenging backdrop for share price, higher interest rates contributing widening discount over the period. If we look at Greencoat UK Wind, similar sort of story. Its NAV's down a little bit, driven by rising interest rates and power price movements. Despite that, made several NAV accretive investments, and once again, dividend looks very, very strong. They paid a total dividend of 10 pence per share against 8.76 pence per share target, which was 2.1 times covered. Manager also sees significant upside from power price rises, asset life extensions, asset optimizations, potential for new revenue streams, and just further softening of interest rates. They say outlook for the group is increased or extremely encouraging. Two property things I just wanted to briefly talk about. Segro has raised 907 million in a placing at 820 pence per share, which I think shows just a lot of confidence in that company. And given the sort of backdrop for property being very difficult, I just thought this was particularly interesting. Market is obviously quite happy with this because share price was 870 pence this morning, up 3.4% a day, and actually it's been heading up since all of this was announced. The capital raise was at a small discount to the prevailing share price, 3.4%, but a chunky premium to NAV, which was 907 at 31st of December. Most recent annual results, and I think this is why they've been able to get the sort of price they have, showed decent rental growth and actually very sort of favourable occupier markets that is supporting said rental growth and actually dividends. And also they've been doing good stuff on the asset management side. Hammerson, their results were out. Once again, this is an area people have been worried about, but actually good growth in their earnings, 11% on their adjusted. This had a record year for leasing. 306 lettings, 46 million of headline rent, up 23% on a like-for-like basis. New perm deals signed 30% or 37% above previous passing rent and 12% above ERV. As I say, there were some other interesting results from Unite Group and Shaftesbury. Haven't got time to go over those, but so you may want to have a look at them. Right. Time to bring on Mr. McHattie for his regular shop. Over to you, Andrew.
That's great. Thank you very much indeed, Matthew. I'll just share my screen and we'll talk about the movers for the last month. It was an interesting month, actually, February, because whilst many global markets were of course hitting new highs, and that was true across the US, Japan, and Europe, it was a fairly dull month, actually, for the investment trust sector overall, with a rise of about 0.5% in the investment trust index. But there were some rises, as always. I think these were not generally that exciting. Many specialist trusts at the top that had some unusual factors. But I will talk about a couple of these in greater detail. Chrysalis and CC Japan. You can see there were not that many trusts actually posting double-digit gains in February, which I think speaks to that rather dull nature of the markets, the sector's response to these broad equity market gains. On the way down, there were actually falls of more significance, I think. And my sense here is that many of these were interest rates related. There was a lot of optimism in January, I think, about the future path of interest rates and how we might get cuts in the second quarter of this year. I think as the inflation numbers came in slightly higher than anticipated, that initial wave of optimism that we often see in the new year dissipated quite quickly. And that meant actually that interest rate sensitive sectors gave up some of the gains or came down a bit. So on this list of fallers, there are quite a few REITs on here, and also renewable infrastructure more broadly. Those are the interest rate sensitive sectors. But just as you were saying, Matthew, I think there's some interesting stories actually in the property sector, which is, of course, a cyclical industry. This is not undergoing some kind of massive secular decline as a result of these interest rate rises. So I'll talk about three of those trusts as well. So let's have a look at Chrysalis, which had a good month. I think in some ways, Chrysalis is a bit of a poster child for the growth sector. It's certainly a very high profile trust, not least because the managers banked an enormous performance fee on the way up, you'll remember, which of course hasn't worked out that well for shareholders because the gains soon reversed. You can see from the 3-year chart here, there's been a very rough period for Chrysalis. It's really been a very, very bad faller over this period. And I think there had been a couple of moments of false hope where people thought maybe it was recovering. But I think we are now in another phase where I think there's a broader belief that the recovery cycle may be beginning. I think we've seen this actually in a few of the growth-oriented trusts that I follow. Things like Seraphim Space and Syncona have certainly bounced well off their low points. And we've seen that with Chrysalis too. And I think it's justified. The last quarterly NAV was showing actually a reasonable gain of 6.5%. And whilst I think there's been a lot of quite understandable skepticism about the valuation of private assets, I think there's actually quite a lot of evidence building that the valuations in most of these trusts have been fairly reasonable. And in some cases, they may be undervalued if you're looking forward. And the big story, really, that I think that's driven Chrysalis shares over the last month has been Klarna, which is its fourth largest holding. This is quite a well-known stock, Klarna. And the belief is that it could choose to float later this year. Could be in the third quarter, maybe the fourth quarter. And the valuation range, I think, has been subject to quite a lot of talk and discussion. The most recent range I saw was between 15 and 20 billion US dollars. But I think the belief now, the most recent reports anyway, are that the pricing could well trend towards the top of that range. Now that's relevant for Chrysalis because it's currently valuing its stake in Klarna at about 11 billion market cap. So there's potential there for quite a big uplift in the NAV if this transpires. And of course, it's a very big if. But I do think it's interesting for the share price because, of course, it is on a huge discount. And the trust has said that realization proceeds will be applied partly to share buybacks. Certainly, there'll be some return of capital to shareholders. So, as always, this kind of stock comes with quite a heavy risk warning, I think. But nevertheless, I think if you are considering introducing a little more risk into your portfolio, then some of these growth investments that you may well have shunned for quite some time, I think are looking quite interesting again. So worth thinking about. Moving on, there are not many charts I could show you on the 1-year share price that do start as we'd like in the bottom left-hand corner and move to the top right. So I think it's worth tipping our hats actually to CC Japan Income and Growth. Of course, Japan has finally hit new highs after more than 30 years. So it's quite extraordinary actually that it's managed to achieve this finally. And CC Japan has been one of the better trusts of late because actually it's been a bit disappointing. The Japanese investment trust sector has been a bit of a disappointing hunting ground because in 2022, trusts were really held back by being largely growth oriented, which was the wrong place to be. And then in 2023, these are, of course, trusts that are providing you with a sterling return. And they were very much hampered by the weakness of the Japanese yen, which reduced the returns in sterling. So actually many of the returns have been rather disappointing if you compare them to the headline Nikkei 225 returns. But CC Japan, I think, has stood out. It's a more value-oriented trust. It's done very well. And I think on the one hand, it does have actually quite a low profile compared to some of the other trusts. It's a bit smaller. But actually, the market has given it a premium rating against its peers, and therefore you could argue its performance is actually recognized by the market. The discount's about 2.9%, which is certainly narrower than the sector average for mainstream Japanese trusts, which is more like 8 to 9%. And you get a dividend yield here as part of your return, which is actually quite unusual for Japan. So I think it's interesting. And one big factor here is this exchange rate, which has been a really significant headwind actually for sterling investors over quite a long period now. And of course, it's an impossible task to try and call the actual moment where that's going to turn around. But I think both anecdotally from people who've been to Japan and tell me how cheap it is, but also I think from a technical perspective, it does look as if the yen is probably oversold. And there could well be some policy changes to come from the Bank of Japan, which could well prove a trigger for that to shift. So on the balance of probabilities, I would think there's a decent chance actually of the sterling yen exchange rate turning around and that becoming a tailwind for sterling returns rather than a headwind. So in spite of the new highs being hit by Japan, I don't think it's too late to invest. So let's get into the negative parts of the market now, and real estate has been very much a part of that. There are a few trusts I'd just like to mention. One is Life Science REIT, obviously a specialist trust which is focused on the magic triangle, the golden triangle of Oxford, Cambridge, and London, providing space to life science companies, mainly for laboratory space and that kind of thing. Now, there's a lot of demand in that area. There's a great deal of material which demonstrates that there's a lack of supply for these companies. And generally, when space does become available, it gets snapped up quite rapidly. And yet, these shares are very much unloved, as you can see from the share price chart on the right. And the assets, I think, have been fairly resilient. They have come down a little bit, but actually the discount of more than 50% seems to me to be excessive. And there are some factors, I think, that could support the price here. One interesting point is that as part of its management agreement, the investment advisor takes part of that in shares, or is required to buy shares. So they did buy just over 200,000 shares in January at 63 pence. The price is much lower now. But there has been some good background news here. The trust is actually being quite successful in letting new space, and it's just announced a new lease at the Oxford Technology Park, which is an extra £1.15 million of rental revenue per year. I think maybe what's happened here is that there are just not many buyers actually in the real estate space. And that is a problem for all kinds of trusts in the sector. And where the shares are illiquid, it means if you get a few sellers and not many buyers, the gap opens quite quickly and the shares come down. It could well be that with some better news, these will bounce back, and the full year results from the trust are due on 26th of March. I think they're worth listening out for, and it could well be worth a read, because if the underlying momentum in the business is actually being maintained and is quite good, then this could potentially prove an opportunity. One trust in the sector that we know quite a lot more about because it's been around for longer and is more well established is AEW UK REIT. And this really has been the sector leader, I think, in the UK mainstream, in the commercial property space. Over quite a long period now, I've ranked this table here by 5-year NAV returns. And we can see this trust is quite clearly top, as it is over 3 years. I mean, really outstanding over 3 years. and it's not far off over 1 year as well. It has a really consistent track record. The managers seem to do a very good job with the asset management, where they're adding a lot of value. And so I think it's a bit surprising to see the shares going down actually quite sharply. And that probably speaks to the general distaste that investors have for the real estate sector at the moment. Over the last month, these shares were down 12%, which I think doesn't really chime with the NAV being much more stable. It was down in the last quarter of 2023, but only by 2.3%. Earnings were stable. And I think it's a bit puzzling, really, that the discount has widened out to 16.2%, which is more than twice as wide as the 12-month average here. And you're getting a very supportive dividend yield of 9.6%. So again, to me, I wonder whether the shares may be oversold because of a general sector movement here. I don't think there's any particular problem with this trust. Famous last words. The last slide here is about trusts that are bidding for others. Because, of course, one aspect of the wide discounts is that it has encouraged corporate activity. And we're seeing quite a lot of merger action in the sector. One of the latest was from Tritax Big Box REIT, which is the chart on the top left here. That has bid for UK Commercial Property Trust. There's quite a lot of Aberdeen interest there, and I think that deal will probably go through. The major shareholders have indicated their support. But nevertheless, this was not good for Tritax Big Box shares. And you can see there's a quite definite dip here, which was on the news. And I think what's happened is that this is an all-share bid. And when all-share bids occur, it's almost inevitable there's going to be some kind of overhang of shares, because the holders of the trust that's being bid for are not necessarily going to want the shares in the new one. That's just human nature to want to reassess your holding at that point. And obviously the portfolios are somewhat different as well. So it's quite rational. So we have seen this, I think, replicated a few times across the sector now, where you have a bidding trust that has suffered in share price terms once it's made its announcement. And I think this is interesting. In some ways, it's counterintuitive because, of course, generally the bidding trust is the strong one, and it's making a bid for a weak trust. And so you might think, actually, this would be quite good for its shares and it would benefit from the arrangement and the shares would go up. But we've regularly seen bidding trusts suffer in share price terms. I talked last month about Custodian Income REIT, which really had a sharp share price decline when it bid for Aberdeen Property Income. In fact, so much so, given that this was an all-share deal, it made it actually somewhat less attractive for the Aberdeen Property Income shareholders, which encouraged a counterbid then from Urban Logistics, Shed, which also, again, suffered a bit of a share price decline when it made its counterbid. It's not just happening in the property sector as well. We've seen it elsewhere. So RTW Biotech Opportunities has just successfully completed its acquisition of Arix Bioscience. Again, in the middle of the month here, we saw a significant dip in RTW shares as that deal went through. And I think that had to be really because some of the Arix shareholders were selling out. So beware of stock overhang, I think, when you're holding trusts that might be bidding for others. Okay, I don't think we have any questions. So that's it from me, Matthew. I will hand back to you now to have a chat with Charles. Thank you.
Thank you very much, Andrew. Right, I will just quickly share my screen again. Hopefully that works. So you'll see that. Obviously, there's the usual disclaimers. I'm going to bring Charles on in a second. I just wanted to quickly address a question from Kevin Wilson. He says, when do you think HICL will restore dividend increases? So I mean, they've had this 8.25 pence target for a little while. That's the same for this year and the same for 2025. I mean, I think they've actually got the capacity do it sooner rather than later if they want to. If you look at the cash cover in the most recent results, excluding the disposals, which obviously pushes this up, it's 1.05 times. So there's room to do that, and there should actually be, inflation adjustments coming through. The reason they say they're not doing it is actually they've got a number of PPP concessions rolling off. And I think at this stage, they don't know what they replace those with and what the yield would be like. So that is really why they're being cautious. I was just quickly trying to find what the profile that looks like. I haven't been able to find it. But I think we'll sort of look into that and try and come back with an answer. But I think they could do it. I don't think they're necessarily under pressure because it's throwing off a 6.7% yield. And I also think that with a discount where it is, they're going to be sort of focused, a bit like with this buyback, returning cash that way. Hopefully that helps sort of answer that question. But I think the big thing is if I can just work out where those PPP concessions, where the sort of fault line is in those. Right. Okay, hopefully we can now bring in Charles. Charles, are you there?
Yes, I am.
Brilliant. So probably many of you know Charles, but I'll just quickly run through who Charles is. So Charles, Director of ICM and Chief Executive of ICM Investment Management Limited, where he runs UIL Limited and Utilico Emerging Markets Trust, which we're going to talk about today. Charles has over 30 years of experience in international financial markets, most of which he's got from sort of time at ICM. Let's say he's qualified chartered accountant and extensive experience in corporate finance and asset management. Charles, would you like to give us a sort of extended elevator pitch of why we should like UEM, please?
Matthew, would be delighted. And I think I shared some slides with you, and if we can just use that for context and maybe go to page 1 of the presentation.
Okay.
So trying to, if you want, give you an overview. Top right, predominantly emerging markets. So we're focused in on, countries like Brazil, India, Vietnam, the Philippines, and over 95% of the portfolio is invested in those markets. Top left, operational infrastructure and utility assets. I think we're unique in our approach across the emerging markets to focus in on that asset class. There are more than enough investment opportunities. And by being a specialist, I think we can find the ones that will deliver the long-term returns we're looking for. Just to emphasize operational infrastructure, 95% of our assets are listed on stock exchanges, and again, over 95% are operational. So they are owners of a runway, an airport, a port, a toll road, as you were talking about earlier, transmission lines. And we're looking at those assets and how they can perform and what the drivers are. And I think that the nature of the asset gives us a lot more confidence about the outlook when we're making investments. Bottom left, just to note, we are bottom up. So we don't start out with a view on a weighting in the portfolio. We're very much bottom up. We're relentless. We keep behind management teams in terms of understanding their approach to the business, just making sure that they deliver to the expectations that we are setting. Benchmark agnostic, as I've noted. I always comment when I come in that I don't think anybody in our office would be able to write down the components of the MSCI index. It's an outcome, and in terms of bottom up, our portfolio is an outcome. Long-term investment horizon. I think the nature of our assets are that they're here for 30, 40, 50 years. And therefore, we can look through to, if you want, the medium to longer term economic drivers. And especially at the moment, where there's a huge amount of noise in the wider markets, that opportunity to look through and say, the asset will return and perform in time, what's it going to deliver to us, I think is the real strength of the proposition. We do build in ESG. We have our own template because most of our investments are outside indexes. We've developed our own template, and it does go into, if you want, the decision tree. We're not driving for outcomes, but we're definitely trying to engage with investee companies on their journey. The upshot of all of this is a strong return. Bottom right, however you want to measure it, whether it's a year where we were up 10% through end of January versus the index, which is down nearly 6%. And, we've been a good short-term, medium-term, and long-term performer. So happy with the outcome. To try and unpack it a bit more, the next page. So unique features, we are exposed to the megatrends, and I'll come on to those. There are 4 megatrends that we feel are driving, quite frankly, global economies, but they absolutely apply to the emerging markets, and I'll come on to that. We are focused on utility and infrastructure assets. So, as I say, things like ports, airports, stock exchanges, things that have a monopoly characteristic, and we can have a look at their business models and rely on their defensive moat to deliver the values looking forward. Real assets, as I've stressed, they're operational. I think something to note, we continue to see top line growth at the moment in terms of volumes. We continue to see pricing firm. And while costs are rising because of inflationary pressures, I think at an EBITDA level, they continue to outperform quarter on quarter, year on year. Most of them have long-term stable cash flows. They're predictable. We can model them out. We can hold management teams to account. And I think that's a real benefit because we're not seeing huge dislocations within the underlying investments. Experienced management team. I've been with the fund since it listed in 2005. I think we've got a long-term track record. It speaks for itself. And we do absolutely look for the best opportunities. Strong performance, as I've commented already, I think the numbers do speak for themselves. One thing to note, though, is we do have a low beta. It's not something we manage for, but it's an outcome. We have a low beta under, I think, 0.8. And so the performance that we're delivering is in the shares that we are putting into the portfolio. So it's a real validation of our process. And to note, over 98% of our portfolio is an active share, i.e., I think investors would struggle to make a comparable set of investments to us if they were looking to funds that are nearer to the MSCI index. Yeah. Next page. So megatrends. And just to note before I get into megatrends, we are still seeing the underlying characteristics, in my view, of emerging markets. So I was in Vietnam in November, and you can see the rate of urbanization is still very evident. And I think their urbanization rate is running at about 40%, and it will continue for some time. And that's the case in most emerging markets. So we're still seeing cities grow. We're still seeing a middle class within cities grow. And they're the users of, if you want, our portfolio. They're the users of the airport, of the data centers. But notwithstanding that, I think globally there is a lot of change underway. And this is mirrored in the emerging markets, and at times stronger because they're starting without legacy assets. So energy transition, they are clearly focused on achieving net zero targets, and investing significantly into hydro, into wind, into solar. And very often, as in the developed markets, the wind resource, if you want, is not where the urban population is, and therefore you need very significant investment in transmission lines. And so we're seeing a lot of really attractive investable opportunities, and that energy transition will continue, we think, for the next 10 years. There's clearly also in the background a degree of energy resilience, where countries are looking at exactly where they're sourcing energy from and how can they make their own economies more resilient to the energy challenges. Digital infrastructure, I think everybody's on the same page here. The emerging markets are behind in terms of penetration, but the characteristic is exactly the same. The growth rate is bottom left, top right, and that continues to be a very strong trend. And I think if I look at AI and the demand for data, the use for data, it will continue for some time. And certainly within our portfolio and within our discussions, we're seeing that very strong trend. And that, again, that should continue for 10 years. Global trade, I know a lot of people come at us and would say that global trade is challenging, it's flat, it's not at the growth rates that it was 2, 3, 4, 5 years ago. That's true. But I think what is happening is an absolutely monumental shift in, if you want, trade relationships. So we're seeing friction between the US and China, and that's spilling over into what's termed China plus one. So corporates are looking at where their production facilities are located, and they're not leaving China, that's for certain. But the next decision to invest would be in, say, a Vietnam. So you see Apple looking to invest in Vietnam. You see Tesla looking to invest in Mexico. And that shift is providing a real opportunity if we can identify the ports, the logistics infrastructure that will benefit from it. And again, we think that this will continue for some time. And finally, social infrastructure. Many of these countries are on a journey to achieving better outcomes for their urban populations. And legislation keeps being introduced to support the deepening and development of social infrastructure. So things like waste treatment in Brazil is a big beneficiary of legislation that was brought in 4 or 5 years ago, requiring a tidying up and an improvement of waste treatment. And these 4 megatrends, we think, give us real confidence when you marry them up against, if you want, the normal dynamics in an emerging market because of the nature of the assets that we're invested in. The next page. And I'll try and just skip through the next 4, but just to give you some feel, you can see a picture. Here's a wind farm in Brazil. It's our number 3 investment. Their major asset is the transmission lines, but they are adding to their portfolio. You can see wind farms. And while there are challenges, I think better management teams are able to bid for assets and then bring them online quicker, bring them online at a lower cost, and operate them at better outcomes. And the returns that are available are significant. So we see this as a very attractive space for the next 10 years. Next page. Data centers, as you'd all understand and agree, there's bottom left, top right, driver here, and the emerging markets are absolutely no different. We're seeing a number of investments in our portfolio in the data center space, quite frankly, filling up as quickly as they can add capacity. I think the big trick with a data center is to make sure it's a bit like property. It's location, location, location. You want low latency. You want connectivity to be high. And the assets that certainly we've got are benefiting from a demand for capacity. And I don't see that abating for some time. And that's a real attraction for the portfolio. And some of the management teams in this space, if you take a company like an FPT, which is, I think they are now 5 billion market cap US dollar, based in Vietnam, their growth dynamic is very significant, and they've delivered a strong performance year on year for the last 5 years, growing top line by 20%, growing their bottom line by 20%. And if you talk to management, their expectations are almost for an acceleration given the footprint they now have. So exciting business to be an investor in. Global trade, next slide. I think I've highlighted it. There are, as I say, two factors here. One, China US friction and the shifting away from China. The other is, I think, a real focus on supply chain, which came out of COVID as a big driver, where corporates found themselves dependent on a very narrow and a very efficient supply chain. But when it got disrupted, they found that their business models were properly challenged. And so they are looking to diversify away from a sort of single supply chain, and they're looking for multiple supply chains. And they're also looking, I think, for supply chains which are a bit shorter. And so you're seeing a lot of what's called nearshoring. And all I can say is, having been to Mexico in March last year, and I'm going in 2 weeks' time, and I'm sure I'll see it again, the warehouses are full because industry is relocating manufacturing into Mexico. And you can see from the graph bottom left that the emerging market share of global trade is continuing to grow, and that's a real strength for us. So a lot of dynamic in this space, and therefore a lot of opportunity. If I go over to social infrastructure on the next page, as I've said, this is driven by need for clean water, the need for treatment of waste, the need for better outcomes for middle classes. And a company like Horizon, which is acquiring a number of waste sites across Brazil, and then taking them on the journey of not only being a waste site and they get paid a fee for taking the waste, they're sorting the waste and earning a fee from recycling. They are capturing, if you want, the methane and energy, and looking to sell it back into the grid. So all of that drives a real outcome. I think, and I do recognize time's running on, I think just over the page, a couple of highlights to note. Inflation has not been a factor for the portfolio. A lot of our assets are inflation adjusted, and therefore it hasn't been a factor. Interest rates, the portfolio tends to be lowly geared when you look at the sort of developed world sector. And why is that? I think their opportunity is raw growth. Their opportunity isn't to leverage a balance sheet. So it's not been a real challenge over the last 12 months. Geopolitical tensions, I think as an investment team, this probably takes our most attention. But I think our strength is being able to look through, if you want, the noise that comes out of, say, Lula in Brazil, and understand what's happening in the real economy. couple of final things on the next slide. And you'll have heard this before. Emerging markets are undervalued. If you look at the 10-year average on the left, we're significantly undervalued. If you looked at our portfolio, we're absolutely no different. And I think our portfolio is yielding, giving you a sector leading performance. We've got a high dividend yield and we've got low volatility. And our discount on our shares is clearly giving you an entry point. I think on two other points just to highlight, because I do recognize the time. If we jump 2 pages, clearly the performance has been extremely strong and consistent, and we're very proud of that. We obviously want to see the discount narrowed. We do buy back shares. We are consistent in the market. I always look at the portfolio and say, I'm happy to buy the entire portfolio. So why wouldn't we buy back?
Absolutely.
Dividends are a strong feature. Next page. We pay our quarterly dividends. It's an outcome because of the nature of our assets, which are cash flow generative, over 80% pay a dividend, and we obviously pass that on to our shareholders. And that's an outcome that will remain and consistently underpins. So I think that's giving you, I hope, a real helicopter view.
Excellent. Thanks for that. We've got sort of quite a few questions coming, so let's flip over to those. Now, the question here is, what processes does UAM go through to calculate appropriate risk premiums for utility and infrastructure investments? I think probably the broad question is, how do you balance risk and return when you're assessing investments? I'm guessing probably a good understanding of the regulatory environment, local politics is key.
Absolutely key. So I think experience of how the local markets respond over time. So regulatory framework and performance is important. I think very important is to make sure that we have a diverse portfolio. None of our investments are above 5%, and that's a conscious decision to try and take out, if you want, the downside risk of an investment getting into trouble. And it's a competition to get into the portfolio is the best way I can describe how do we look at investments.
Right. Okay, no, that makes sense. Just sort of, I guess, related to that, what's your approach to, or what's the gearing policy with this? I mean, I imagine it could support gearing just because these are cash generative assets that are mission critical for society. But I mean, do you guys employ gearing? How do you go about managing it if you do?
So we've got a £50 million facility. We're a 550 million gross assets, a 10% facility. Today is 25 million drawn. Probably says to you we are positive, so optimistic, but we're a bit cautious because there is a lot of dynamic in the wider markets.
That makes a lot of sense. What does the interest rate look like on the facility?
It's about 130 basis points over the currency we borrow in.
Yeah. Okay, that makes sense. All right. Next question. Now, I guess the answer is you've got quite a decent exposure, but the question is, how have managers gone about anticipating the effects of climate change on the investment portfolio? Well, clearly this could affect everything, but you're specifically targeting the energy transition, aren't you?
We are, and it does factor. I think, we do look at things like El Nino and all these climate impacts on the asset that we're investing in. And, the opportunity to invest does range across river, transportation, etc. I think we'll put a higher premium where we think that climate could have an immediate impact, but it certainly comes into our discussions. It certainly comes into our thought process.
Okay, that makes sense. Oh, somebody's asked you, can you explain the structure of your credit facility? But it's a multi-currency credit facility, is that right?
It's a multi-currency revolver. Yeah.
And we understand this, so I think we've answered that already. So let's dismiss that. Said, what strategies are in place for achieving dividend growth greater than inflation? I mean, I think you were saying that really the dividend is a consequence of the investments, isn't it? Rather than something you're specifically targeting. But can you expand on that at all?
It's an outcome, and I expect it to continue because of the nature of the portfolio, whereby they're cash generative. And one of the things we do is make sure that the shareholders are aligned with us, that they do want to see growth on the one hand, but on the other hand, they do want to see a dividend.
I mean, perhaps related to that, because obviously, the inflation that we're experiencing here is going to be different to what is being experienced in your markets. I mean, typically, actually, it's sort of lower inflation there, albeit, we're possibly benefiting more with the sort of state of the sterling, as it were. But sort of how much inflation linkage do you think there is in the sort of portfolio?
It varies. I think Latin America, inflation is actually a big issue, and it's something that we do take into account, but it's always had inflation and manages its way through. I think Asia has been much more about property across most of those markets, and inflation hasn't been a real issue. If you're honest, China is actually facing deflation.
Yes, absolutely. Got a question here. Somebody's obviously noted that you've got a decent slug of the portfolio in India, and sort of asking about your general outlook. I've just got a sort of my own question related to that. Is that something, because obviously the Indian market has done very well. I mean, how have your holdings performed, I guess, in that sort of context? And is that something that you've had to trim back at all, or has that not been much of an issue?
So it's asset by asset almost, but we've seen strong benefit from investments in India. Modi is doing an extraordinary job of opening up the economy and enabling the economy to perform. So electrifying and putting in transport infrastructure has been an enormous driver. We have 2 or 3 investments. One is in Power Grid India, which is the biggest transmission company, I suspect, in the world. And they have a really good, strong management team and strong performance.
Yeah. I guess sort of related to that, there's a question: do you sort of have an outlook on the Indian election and what will sort of happen there? But there's actually a sort of related question, which is, are there particular regions or sectors where you see opportunities or risks stemming from the various upcoming elections? So I suppose we could include India in that. Do you have any sort of views?
So most of them, India, I'm putting on one side the politics. We expect Modi will be re-elected, and he's been good for the economy. So why wouldn't it continue? I think Indonesia, where we have seen a change, we still expect the approach to be a good outcome for, if you want, investors. So we'll look at the underlying dynamic, if you want, strength of the institutions and the underlying dynamic in what's the policy the government is seeking to follow.
Okay, that makes a lot of sense. I think apologies to those that we're not going to be able to get all of the questions. I think we've got time for one more. And really, it's just asking what the sort of rationale is behind having, they say, sort of close to a quarter of the portfolio in Brazil.
So we've understand Brazil, I think, over the decades. We've had 30% before, down to 8%, back up today to 24%. It's an outcome. A few things, or 2 things I'd note about Brazil. One, there is a significant amount of oil coming online from offshore pre-salt that is now coming into the economy. And this is a country that does not need energy. Most of their energy comes from hydro, wind, solar, and therefore it ought to be a proper elevator or underpin for the currency and the wider economy. I think also they've invested very deeply into logistics and supply chain, all of which ought to give them resilience in a global economy facing change.
Brilliant. Okay. Well, we'll have to leave it there. But look, thanks, Charles. That's been really helpful, useful insight into what's going on with UEM and sort of the outlook, etc. Hopefully, we'll be able to get you back on, I don't know, about a year's time, and you can give us an update again on how it's all going. Saying once again, thanks to Andrew. That was another excellent sort of update on the month that was. If I just skip forward, there's the sort of usual legal bit we have to give you. If you haven't got a chance to read that now, perhaps pop back and have a look at that sort of later. As usual, we've got plenty more events lined up. So as you can see, we're booked through March and I think into April. Come back next week. I think James should be here talking to Richard Aston of CC Japan Income and Growth. And then on the 15th of March, we've got Stephen Treasure of Oakley Capital Investments. And then on the 22nd of March, we've got our first quarterly panel discussion, which obviously has, these are entitled, Has the Tide Long or Tide Turned? As I say, we've got things going into April as well. But say, thanks very much for joining us this week, and we will be back next.